Hi, it's Eric. Today I'm going to go over a new investing strategy in volatility ETFs, which were completely new and which returned a really great rate of return for me. So I've compiled this chart in this presentation where you can see that the rise of ETF is just going exponentially since, especially since the financial crisis in 2008. So it really spiked 2008, 2009, 2010, 2011, and went the same trend um, until 2013 and 2012 with 1.95 trillion assets under management in global ETP. That includes all the commodity ETFs, but also the ones which I will be getting into, the volatility ETFs. So, a bit of history: VIX futures started trading in 2004, and options on the VIX futures started trading in 2006. The use of VIX options dramatically increased post 2008 crisis, and currently there are 5 billion in all VIX exchange traded products, short-term futures, mid-term futures, inverse and leveraged exchange traded programs, and other VIX strategies. So the largest assets in there are the short-term futures, so the 1 and 2 months upfront, which are about 3 billion invested. So I'm going to go over the volatility dynamics trading tools and the portfolio applications. So especially the ones I like are the ETF SVXY and the UVXY. Those are the tickers, as well as the ETN XIV. Why are they very interesting? Two things. They are mean reverting. Nature of the VIX means that you can, sell volatility when it's around 25-30 and buy it below. I'll focus here more on strategies which also and moreover use the VIX term structures to your advantage. The VIX futures are almost often in contango, which means that you can earn very interesting rates of return by using the term structure to your advantage, which I'll show you in a minute. So this we did. So they're almost brand new. The Black-Scholes models in 1973, 2009. Here it's where I'm going to focus on. 2009 is where the VIX futures indices, ETNs, and ETN options started trading. And 2012 VIX EMA futures based on EMA ETF options. And where the products which I like to trade started to were created is in 2011, which is only 2 years ago, almost 3. So volatility is mean reverting. That's the first part of my strategy. Is volatility is mean reverting when it hits above 80%. That's very rare. That was with the Lehman crisis in 1930 and just after 1915. So here in 2000 we see that definitely it's always mean reverting and it's coming back to the mean. So today we're at around 12, just above 12. So we're at historically low marks, but I expect volatility to remain within the 12-30 range. The VIX spikes when the market crashes. That's well known when the VIX, which reflects the cost of implied volatility in the options, rises. When the cost rises, the VIX increases. When the market crashes, cost for protection increases. Everybody wants to buy puts, and therefore VIX increases. But you can see that there's very interesting negative correlation. It's about 0.7, minus 0.7. I read a study about that done by ProShares, where they pointed out that over the period of time from, I think it was 990 to 2000 something, over 10-year period, it was minus 0.7. So that's something to keep in mind. The VIX spikes when the market crashes, so that's very good. You can be greedy when everybody's fearful, and you can sell when it's in a good time. So the rolling methodology, which is very important for the strategy I'm going to show you, is for basically VIX futures index roll into a portion of their long-term futures position on a daily basis in order to maintain a weighted fixed term to structure to expiration. That means the 1 month for the short term and the 5 month for the midterm. You can read that in more detail in the prospectus, but that's how the ETF SVIX works. And the UVIX also leveraged in the opposite way. The reduced market impact of the rolling process compared to handling rolls on a single or a few days. So I mean, every day the asset manager is going to sit in front of his desk and basically sell the futures which are coming due in the coming month and roll into over into month 1 and month 2. Every day is going to do that. So that's why there's a negative roll yield. The prevalence of the VIX term structure, contango, the VIX term structure is almost always in contango. It's roughly 90% of the time. So that's why you can have very interesting negative roll yield for people who are long volatility, or positive roll yield for people who are short volatility. So negative impact on futures index performance for the people who are long, and big positive impact for the ETFs that are short. Plus you have the rolling when future prices are in contango involves selling lower priced and buying higher priced futures farther from expiration. So it's a very interesting strategy, which it's more a bet on the term structure than on the level of the VIX itself. So term structure is upward sloping, leading to a significant roll cost. This is what I discussed before, and you can see that the monthly roll can be sometimes up to 30%, which was the case in February 2012. In March, it then dropped below 10%. So the roll cost can be is very volatile, but it still remains positive. So if you're long, you will get burned. If you're short, you take a big advantage of the roll cost. So that's very, very interesting to know. And that's why I'll show you the both impact, because here a picture is worth 1,000 words, and you can see that the UVXY ticker is going down almost 99% over 2 year span, just because of the roll yield. I mean, the VIX level has surely has fallen, but it's more of the continuous rolling over of this ETF, which is which is betting on double the performance of the VIX per day. So it's leveraged, plus it's going down. So if you have the capital and if you are able to time this ETF, the UVIX, I mean, you can definitely play from the short side. It's a sure short. It will go down. It will reverse split again, and that's, I mean, when it hits something like 5 or 4, it reverse splits. Right now it's around 16, so then it will reverse split in, I think, in a couple of months. Will reverse split, and then it will continue to slide again. Very, very interesting, because it's to play from a short side, because of the massive roll cost that this thing incurs, because it's doubly leveraged. The impact of positive roll yield, that's one is the SVXY. So this one started trading at around 20. It's now up to 140. That means almost 6 times your money. I mean, here 5.3 or 5.4 times your money on this one. This is the one I like. I mean, I entered this one a couple of months ago, even earlier this year, during the summer. It's already returned me quite a lot of money, and I will definitely continue to line up on that. So I think that's a great ETF, SVXY. It bets on the negative side from the VIX, so it has one, it rises when the VIX falls, plus it takes massive advantage from the contango in the VIX term structure, which is today at roughly 8% in the coming month, 7% in the coming month, and 8% over 1.5 months. So this one is really, really great to play from the long side. Plus, there's another thing, is that the VIX futures are less volatile than the VIX spot on the 1 and 2 months. So when there's a big crisis like Lehman, this ETF, um, well, which didn't exist yet, but when it was a flash crash, I mean, it didn't go bankrupt. Sure, with the financial crisis, there was the big the big the big spike in volatility, which hit 80. But still, I mean, the SVXY didn't go under. I mean, I think ProShares will support it. That's my opinion, and therefore I think it will continue to rise. I mean, I would buy it as soon as the VIX hits 25, 30. Then I would buy it. Right now the VIX is 12, so I mean, I think it's roughly a bad entry point right now. But for the long run, I think with the compounding effect of of the um, the contango and the positive roll yield, I think this is a sure winner. My favorite is the SVXY. It has a positive roll yield. This benefits from massive mean reversion, and investors are typically long VIX calls and exchange traded products, which leaves dealers short VIX Vega. Just, I mean, take the opposite side, take the premium, and it's a long-term strategy. I mean, I'll keep my my ETFs, and I won't sell them anytime short and anytime soon. So that's what I will do. Well, hope you like this presentation, and I mean, if you do, please leave me a comment, or if something wasn't clear, leave it to me. I'll try to get back to you.